All right, everybody, it's 5:03. We are going to get going. Welcome to the fourth installment of our Alumni Zoom speaker series. Thanks for being here. My name is Jay Josker. I'm the Director of Alumni Relations at Canisius High School and a member of the class of 2001. With me today, as always, is Spencer Farrell from the class of 2008, our Vice President on the Alumni Board, and our speaker today is my classmate, Sam Russo, from the class of 2001. Before we get going, I just want to go over a couple quick ground rules. Should be all on mute at this point. I would ask you should be able to unmute yourselves. I would ask that you stay on mute for the first half of the session so we can all hear Sam. And then if you want to ask questions on the second half, you can unmute yourself and go ahead. If you want to ask questions while Sam is talking, you can use the chat function, and I'll try to get through as many of those as possible on the back half of the talk. This is being recorded. We'll put it up on the internet after the event today. Probably it'll go up either Thursday or Friday. And it'll be used by hopefully the students and the schools as part of our new global learning initiative. So without further ado, I'd like to introduce Sam Russo. Sam is not only a Canisius High School grad, but a Canisius College grad. He's the co-founder of two startups, an investor in multiple regional startups, the managing partner at Lorraine Capital, a private equity firm. Ladies and gentlemen, Sam Russo.
Thank you, Jay. Thanks, Spencer. Thanks for inviting me to participate today. I actually drove into the office to do this because I knew that there'd be no place to hide from my two daughters that think that it's dad's summer vacation all the time now. So I figured this would be the best place to do it without interruption. So I figured what I'd do is give everybody just a quick overview on who I am, what I do, how I got to the role that I'm in. A little bit about Lorraine Capital, what we do, why we do it, why we think it adds value, how it fits into the economic landscape, and then talk a little bit about our style of investing, what we do, and then talk about how we think, I think the hot topic now is how is COVID going to impact things, and certainly, if I had a crystal ball, I'd be able to make an awful lot of money. So certainly the caveat is I obviously have no idea what's going to happen, but wanted to share some of our thoughts about, what we see in the marketplace and how COVID is impacting private equity, M&A transaction landscape, and kind of take it from there. So as Jay said, I'm a member of the class of 2001, which has many illustrious alumni that it claims as members. I'm glad that I didn't see many, if any, names pop up on the tiles on the right, as I figured that they'd probably want to break the ground rules and there'd be heckling and that sort of thing. But proud to be a Canisius High School alumni. Canisius helped shape me into the person that I am today, for better or for worse. But certainly learned a lot of values and learned a lot in general. But from there, I went to Canisius College for accounting. My dad, many years ago, when I was a teenager at Canisius, he said, if you want to write your own ticket in business, you should be a CPA, and then you should go get your law degree. And I guess I kind of did half of that, and then realized that I didn't even really want the first half. I didn't even really want to become a CPA, which I kind of learned the hard way when I was at Ernst & Young. But it was great business training. I learned a lot about different industries, best business practices in a short period of time. I actually see a name of a former colleague of mine at EY, and obviously Canisius as well, Devin McDonald on there too. So good to see that name pop up. But so spent some time at Ernst & Young and really built the foundation of kind of business education. I was fortunate enough that my clients had a number of pretty high profile M&A transactions while I was at EY. And that, kind of unknowingly, oh, there goes my motion light. There it is. Unknowingly, that really kind of laid the foundation for, what was to come more than a decade later, kind of looking at transactions through the lens of a professional investor. So I spent almost 3 years at Ernst & Young. Once I got my CPA license, I was, there wasn't much that was going to keep me there anymore. And what I knew at that time is that I wanted to be an entrepreneur. I thought I knew what that meant. And I think to a limited extent I did, but I had no idea how to get there. All I knew was that growing up, the friends of mine that, their families did well, and seemed to have a nice life, that they all seemed to be business owners. And so, to me, that was something that was always in the back of my mind, was how do I make that transition to entrepreneurship? And so, I spent the next 10 or so years of my career in the executive search world, and kind of transitioning my knowledge of finance and business through the lens of, an executive recruiter. And, I started off by recruiting and placing many of the finance people and accounting people that I knew in Western New York and regionally through my time at Ernst & Young and through college. And then I transitioned into more of a business development role, where I actually brought in some larger volume customers that would hire positions through my firm. And within a short period of time, I became an equity partner in that firm. So I was able to buy into the practice, and I got my, kind of first taste of what it meant to be an entrepreneur and to sign the paycheck. And it was great. It was a great experience. We built that business. We worked with a lot of really tremendous people, and really cool for me was I got to work with a lot of great companies, really interesting and knowledgeable executives over a 10-year span. And so I really got a crash course in kind of regional economy. I saw a broad swath of, different industries, different size companies. Most of our customers were what I would consider to be middle market. And so I really got to, gain an understanding of what makes the economy in Western New York and regionally, kind of Midwest, Great Lakes, through Central New York, kind of what makes it tick. And that was all kind of, accretive to ultimately me joining Lorraine Capital, which I've been a part of now for about 4 years. I always knew, as I said before, that I wanted to be an entrepreneur. And what I really honed in on, I'd say probably 7 or 8 years ago, was that I wanted to be a professional investor. I thought that my skill set was best suited to, kind of understand context, learn situations, understand people, kind of fit that into a market, package up an investment thesis, bring the capital to bear, and then and put it all together and try and make some money with it. That's where I thought I wanted to be. But another juncture, I had no idea how I was going to get there. And really what got me there, it was relationships, that I built through the years. And I was fortunate enough to, spend a lot of time with a guy who's now my partner and very close friend, Justin Reich. Justin was one of the, founders of Lorraine. They were very early stage. And ultimately, Justin was the one that pulled me into Lorraine. He thought that, the skill set that I brought would really lend a lot of value to what they were trying to accomplish. And it ended up being, really, for me, at least, a tremendous fit. And I think, for the firm in total, the thing that I point to as being, at the top of the list as to why we've been so fortunate and successful is we got a great team. We complement each other, really, really well. So kind of fast forward to Lorraine, and I guess even prior to that. So I started to do some startup investing, going back about 6 years now. I had started to go to the Western New York Venture Association holds a quarterly business pitch at the Buffalo Club at 8 or 8:30 in the morning. I started to attend those. In 2012, I think it was, the 80 Labs was launched. It was originally in the Buffalo News Building. A good friend of mine, Dan Mankiszewski, was the he became basically the managing director or director of operations for Z80 Labs, but he ran it for the principals. And Dan later went on to co-found ACV Auctions. So ACV was, a company that I was fortunate enough to invest in, and I got, a first row seat at investing in it because of a relationship. So, it really, the value of relationships that you build over the course of, even early stage in your career, it's tough to predict how a colleague that you worked with for 2 or 3 years, or somebody that you ran into that you spent some time with, how they're going to, their life is going to intersect with yours in some way in 10 or 20 years. It's just tough to tell. So anyway, I started to do a little bit of angel investing. Ended up bringing, kind of a small group of angels together. We formed a couple of special purpose vehicle entities that we invested through. It was really just kind of a side thing, but that was what really kind of piqued my interest in the professional investor world. Now there's a bit of a differentiation. I think some of the people on the Zoom chat, Zoom call, they know that there's a difference between kind of venture investing versus more traditional operating company private equity investing, and it really is a huge difference. So most venture investing, when you hear the word startup and startup investor, right, that's typically growth capital. So a venture capitalist will take their money and they will buy into a valuation, buy into a company that's growing, and then that company will retain that cash and they'll use that cash to fuel growth strategies. That's very different than what Lorraine does. When we invest in a company, our capital is going in to take out other ownership interests. That may be a founder, owner, operator. It could be a partnership, a group of partners. It could be an active operator that has a minority interest, and then passive investors that help seed the business. But our capital, while we may inject growth capital, and when we acquire the business, there's likely some sort of recapitalization that takes place. Our capital is largely going in. We're a buyout shop, so we're buying controlling interests in existing operating companies. But our capital largely goes in, and it goes into the seller's pockets. So it's very different. What I like to say, in terms of what we expect for outcomes, depending on the stage of the venture investor, they need to do 10 deals, and if they're doing it right, depending on the stage, they probably have one deal that goes tremendously well, maybe 2 or 3 that go some flavor of good, okay, or maybe return capital and they don't get hurt. And then maybe, 6 or 7 that go belly up. It really is a numbers game. You have to, and the difference between being in the Hall of Fame as a venture investor versus, being in jail, it's pretty razor thin. In our world, for every 10 deals we invest in, we hope that 2 or 3 are home runs. We hope that, 3 or 4 are good. And we know that probably 1 or 2 are going to not go so well. That's just kind of the business we're in. But it's a different risk profile than, kind of venture investing. And I think that's kind of an important distinction. So, ultimately, Lorraine, give you some background on who we are and what we do. We're a lower middle market independent sponsor, private equity company. So what does that mean? So an independent sponsor means we don't invest out of a fund. So every deal that we do, we capitalize individually with a roster of ultra high net worth and institutional investor partners that we've been fortunate enough to kind of build through the years, and fortunate enough that we've had some pretty good, pretty significant successes with. So to date, basically over a 6-year period, we've done 9 total transactions across 4 platform companies. We were very fortunate to have 2 successful exits right before the world came crashing down in January and February, which, you know, they say you can't time the market, and we certainly did, and it wasn't because we anticipated what was going to happen. It was really because we got lucky from a timing perspective. But basically, we're on a pace where we acquire 1 platform company every 12 to 18 months. And that doesn't sound like a lot, and that's because it isn't. And that's for a couple reasons. One, we typically don't buy companies from an auction process. We typically aren't competing for deal flow with other private equity firms. We directly source our transactions, which is, you know, really critical to our value proposition and critical to driving our returns. So what that effectively does, it allows us to negotiate directly with prospective sellers of businesses that we're interested in. And instead of, you know, kind of valuations in our world being driven by supply and demand, you know, supply of good companies or available companies versus the demand for capital, really the valuation is driven based on fundamentals, and we're able to convey that message to our sellers. And if we agree on valuation, then we transact, and if we don't, we don't. But we're able to buy at what we consider to be fair multiples, which helps us protect our investors on the front end. What people don't think about is if you overpay for a company, it has really, really lasting impacts. One, it places a really high burden on the company to grow. 2, typically, if you're doing a leveraged buyout transaction and you overpay, maybe you pay an extra turn or 2 of cash flow more than you feel is prudent to do. Yeah, you buy the company, but you're probably going to do it with more leverage, with more debt, and that can put a lot of pressure on a business. Everything needs to go well. And what I know is, I don't know everything, but everything doesn't always go well. Things go wrong, economy cycle, you know, I mean, we're in the midst of that right now. I mean, if, you know, 6 months ago, somebody would have told you that, you know, there's no live music, there's no sports, you have to wear a mask if you leave your house, people would think you were nuts. But that's where we are right now. So the unexpected happens. And when it does, you need to be in a position to withstand those shockwaves. So we tend to be conservative with our valuations. We tend to be conservative with the leverage that we put on companies. So one particular area of success that we've had is in e-commerce. Half of our portfolio companies have or had, in the instance of one that we exited in January, very meaningful e-commerce presences. And we've been fortunate enough to not only lend some of our relationships in e-commerce that we developed over the years to those companies to help their growth strategies, but we've also been really fortunate to learn from some just awesome teams. You know, we sponsored a transaction. We acquired Bush Industries, which is a furniture manufacturing company in Jamestown. A company was growing at the time that we acquired it, and then for the few years that we owned it, it grew explosively. It was really exciting to be part of. And during the time that we owned that business, we added over 120 jobs in Jamestown, and, you know, invested pretty significantly in the company. In that instance, I was really fortunate to, you know, I was kind of part of the portfolio company oversight team with my partner, Bill, and was really fortunate to have just a tremendous partner in that business and CEO, and Mike Evans was our CEO's name. He's still the CEO of what now is a significantly larger entity through acquisition. But Mike was a guy that, you know, I just wanted to be around so that I could absorb as much as I possibly could about, you know, how he thought about the world, how he thought about their customers, how he built culture, you know, built a culture that people wanted to be part of and that they didn't want to leave, where high performance was, you know, not only an expectation, but was something that people really really strive for. They didn't want to disappoint the company. They really all banded together. So that was something special to be part of. But it was a furniture manufacturing company that over the last 5 years really pivoted their business from being e-commerce as like a almost a tertiary sales focus or channel focus to it became 85%, almost 90% of the revenue by the time we exited the company. And when 5% of your company is growing by 100% a year, it's not that meaningful. But when 90% of your company is growing by 40% a year, it's pretty meaningful. So we learned a lot of really great lessons from that. And we have a portfolio company called Bariatric Fusion. That's a nutraceutical company that makes products for for patients that have had a weight loss surgery, some form of weight loss surgery. That is another business. At the time that we acquired it, it was more traditional kind of B2B sales channels. They did a little bit of direct-to-consumer e-commerce, but over the last 3.5 years, that business has transformed into a direct-to-consumer and Amazon Marketplace king. Makes great products. We've got great brand loyalty. We still have our B2B sales channels, and those are really critical for us driving brand awareness. But it's just the company. It's just tremendous what you can do with e-commerce, the scalability of sales, and to the extent that you've got the working capital and the supply chain to fulfill an increase in business, and how to crack the e-commerce code from a digital marketing perspective, it can be really special. So I wanted to give some thoughts on kind of how we view, our world, lower middle market. So, I guess I should define what that means. We target companies for acquisition broadly in the $2 to $10 million in EBITDA range, or EBITDA is a kind of a proxy for cash flow in most instances. And that can be of varying sizes. I mean, we've seen companies that fit within our financial criteria that are as small as 10 million in revenue, and some that are as big as 150 million in revenue. So it really kind of varies based on the industry margins and kind of what the industry of the company is. But so from a lower middle market perspective, and I could speak regionally to this, we think that there's going to be some valuation compression. Before I talked about, that really our valuation metrics, the way that we approach valuing companies to acquire, that's really less sensitive to the market than maybe some other potential acquirers might be. But we still think there's going to be some compression. I don't think that the compression is going to be as severe because there's still a lot of capital that's on the sidelines that people and institutions want to put to work to earn returns. But we do think that in our region in particular, there are a lot of folks that have been either multi-generational business owners that are either nearing or kind of past traditional retirement age that haven't transitioned their business either from an equity perspective, or they haven't transitioned their business from a partnership perspective or an operating perspective. And those sorts of transitions, I mean, if an owner operator is looking to transition his business and he doesn't have somebody, or she doesn't have somebody identified to make that transition, it's really hard. It's tough to figure out what the alternatives are. And so what we think is happening with COVID, and we've had a number of business owners kind of proactively reach out to us to say, hey, maybe now's not the right time for me to sell exactly. I want to see what the world looks like in a couple months, but we want to have a conversation with your group, because I don't think I've got another 5 to 10 years in me. I don't want to ride out another economic cycle, or I don't want to, risk it that, things stabilize and then the economy cycles again. Who knows what the future looks like. And so we think that is going to cause a little bit more compression on valuation. And, I think you have to remember too that, before COVID happened, I mean, we were basically on riding a 10-year economic high, in a significant bull market. So valuations were high. The thing that we heard over and over and over again 6 months ago from different investment banker relationships, commercial lender relationships, or CPAs, attorney relationships to do transactions we have, were, these auction processes are, it's crazy. Companies are going for really sometimes irresponsible multiples. I think you're going to see a lot of that dry up, and from kind of what we've heard in the market, that's what we're seeing. I think the thing that tempers that is there still is a lot of capital that's on the sidelines. So, I don't think that there's going to be, if a company would have gone for 7 times EBITDA before COVID, it's not going to go for 3.5 times now. It's not like valuation's cut in half, but could there be a 1.5 turns or 2 turns, depending on the industry, depending on how they've been impacted? Has their cash flow been interrupted? Have they had a precipitous decline in sales? Have they had to shut down? I mean, those are all the things that would kind of factor into the valuation. On the flip side, we've looked at companies that the products that they sell, that they make, are in exceedingly high demand. Whether it's medical devices or personal hygiene related products, those are in exceedingly high demand. And those companies, if they were to transact, and I'm sure some have, they likely go for some sort of a premium. Shifting focus a little bit to, how COVID might impact, and I say again, might impact the startup landscape. And I can tell you that both of the startups that I co-founded, we've applied for and received the PPP loan, which is good. And both of the startups that I'm involved, or that I've co-founded, both are, I'd say, somewhat insulated. There isn't really a direct correlation between what's going on right now and either, a sharp decline in business activity or outlook, nor is there like a direct positive bump. It's not like they're selling products or supporting industries that are, kind of explosively growing as a result of what's going on right now. So, I think the tough part is now, for startups that were on a trajectory, in some form or fashion, that trajectory got interrupted. Their growth rate hiccuped. There's uncertainty about their customer base or their adoption rate, or there's uncertainty about talent pools, whatever it might be. I think it's harder on those startup companies to raise growth capital from venture firms. So I think that the capital raising process might be a little bit tougher. And I think also for any startups that, we're at a phase where they might be contemplating an exit, either, selling to a strategic acquirer, or selling to a private equity firm, or going public or whatever. I think that, many of those plans might have been put on pause. And I think right now, just like it's tough to kind of make any sort of correct judgments on, how the U.S. has performed related to COVID, or compared to, our global neighbors, or how individual states have performed. I mean, history is going to tell that. So I don't really know, but I think the same is kind of true for, what the transaction landscape, how existing operating companies that have an operating history, how they'll be impacted, how they'll be valued, what the market for transactions looks like over the next, quarter, 2 quarters, 4 quarters, couple of years. And same for startup companies that are, scaling and trying to, reach some level of ubiquity. So I guess that's kind of the outline that I had prepared, and I'm happy to, take any heckling or questions, from anyone, from Jay, whoever wants to.
Yeah, thank you, Sam. That was great. We have a question in the chat here. What's the typical investment minimum Lorraine looks for?
So investment from a limited partner, that's kind of how I'm taking that question. So it really depends. I mean, we have, in each deal, we have, kind of some friends and family that have been with us from the start that, like to come into each transaction we do. We've had checks as small as $25,000 or $50,000. But typically for a new LP, it would be, somewhere in the $100,000 plus range. And I would say that checks, typically range in size from, I'd say most of them are between 50,000 and 2 million.
Just a reminder, you can use the chat function, or you can unmute yourself at this point and just yell out a question at Sam.
Hey, it's Justin Rinaldo. Can you hear me?
Yes.
Hey, I have a quick question. So you mentioned that you don't go through the auction process for sourcing deals and that they are sourced individually. So can you just dive into a little more detail on how exactly the deals are sourced?
Sure. Yeah, that's a really good question. So really the deals come through relationships. So we have somewhat of a regional focus. I mean, if you draw kind of a 3-hour driving radius around Buffalo, Cleveland, Akron, south to Pittsburgh, Rochester, Syracuse, even to Albany, that's kind of our footprint. And, we do that for a couple of reasons. One is we tend to be very hands-on in terms of building relationships with our senior leadership teams. We think that's really critical to making sure there's appropriate, proper alignment between the investment thesis and the team and their strategies and execution. But we also do that because this is where we have our home court advantage from a deal sourcing perspective. So we work with a lot of really great service providers, CPA firms that we trust, attorneys and prominent law groups that we trust, insurance risk management folks that we trust, and they have really strong relationships with business owners, and so we get typically if a business owner is thinking about selling and just kind of doesn't know where to begin, a lot of times their partner CPA is they're gonna field that call, or their partner at their law firm that's had a relationship with the owner for many years, they're gonna get that call. And so we've built some really deep, long-standing, trusting relationships with service providers. They know that when they make a really valuable introduction to us, they know that we're going to steward that relationship forward, the same way they would, which is really important to them because it's, typically these are high-profile, important customers of theirs. So there's a lot of trust that kind of, goes both ways in order for that to happen. And frankly, we have no problem paying lucrative finder's fees to referral sources that give, that bring us deal flow.
Thank you.
No problem.
Great question, Justin. So we have another chat question from Tom Neal. Bear with me here. How do you market the buy and hold Quasi Berkshire Hathaway investment thesis? Much different than the private equity firm need to flip companies after 5 years max.
Yeah, that's another really great question. So the reality of it is, from an investor perspective, we need investors that are philosophically aligned to that. We think that it's super important that we don't have pressure to deploy capital, and we think it's super important that we don't have pressure to return capital. What that enables us to do is that enables us on the front end to buy good companies that we think can grow at a fair price. And then that allows us to be patient to let those companies mature. It allows us to be patient to not have the pressure to liquidate, a fund in 3, 4, 5, 6, 7 years. That can force you to make decisions, at inopportune economic times. So having that flexibility in the back end is really important. But it makes it really important that you get the right investors that are along for the ride. So when we are raising capital for a transaction, we talk to investors specifically about what we think the prospects are from a hold strategy perspective. When we look at modeling, for returns and such, we typically look at that on a 5-year basis. We put together a 5-year forecast and sensitivity analysis. But we're really looking for folks that are patient. Now, there are other ways to get capital out of a business than just an exit, and we've deployed all of them. So, if you have a healthy business that isn't over-levered, there's and it's cash flowing, you can take a programmatic approach to distributions. Maybe there's a formulaic quarterly distribution that goes out that starts to return capital to equity investors. If a business has grown substantially and gets to the point where it's actually under-levered, you certainly can do some sort of a dividend recapitalization, maybe put a piece of term debt on the business and dividend out to investors, again, responsibly. So there's other ways to generate liquidity for investors, and we've kind of done all of those things. And certainly, I don't want to, I shy away from the analogy of Berkshire because, I think for some obvious reasons, comparing oneself to Warren Buffett's probably not a good look. But second of all, I think that any investment that we contemplate, there is an eye toward what ultimate exit liquidity event could or would look like. And I think to the extent that we didn't do that, that would be probably pretty irresponsible to our investors. But it's a unique way of doing it, and requires us to work with a unique set of investors.
Speaking of a unique set of investors, what do you look for specifically when you're considering a particular transaction, or the things that companies do that make themselves more desirable to you guys specifically? Yeah,
sure. So, I could list off some of the basics like revenue sustainability, revenue scalability, how whenever we kind of get a first look at a company, my first thought is, how does this business double? How does this business triple? What are the things that they can do to generate more revenue? Is it more people? Is it more products? Is it more diverse products? Is it products supported by services? Is it expanding geographies? Is it, channel relationships? Is it, sharpening their competitive differentiation? What is it? But let's assume that there are some basic check boxes that are met. The single most important thing is the team, hands down. A great team will be presented with problems and challenges that they will collaborate and overcome. A mediocre team will do well when times are good, and when times get tough, they won't do so well. They'll kind of go with the breeze. But a great team is really what we're looking for. So, when we see a company that we think can be grown meaningfully, we think that they have a sustainable competitive advantage, we think that they can leverage technology to increase revenue, and we think that they've got a winning team that can not only execute, but develop an author strategy together, that's really the winning combo. And to be clear, if we're ever in a position where we're making strategic decisions for the company, that means that something's gone really, really wrong. The goal is to have people a hell of a lot smarter than us, with a hell of a lot more expertise in the given industries that we're investing in. The goal is to have really strong, ethical, aligned people that are leading these companies. But I would say, given that, kind of a couple key check boxes are there in terms of, a company fitting our criteria, whether or not we invest, it's, can we agree on valuation, and do they have a great team, or can a great team be assembled?
Hey, Sam, this is Tom Neal. Just a quick follow on my question. first of all, thanks. This is really good.
Thank you.
I just retired. I was class of '70, so I knew Herbert Hoover, so I can talk to you about the last depression. But I was a senior lender for about 30 years. My last job there was a division head with HSBC.
Yep.
Great job. Nice to drop at a cocktail party, but all you dealt with were huge companies, and I got sick of it. So I was 10 years with a $250 million mezz fund under Bariatric Capital. So identical market to you guys, and still kept in contact, Summer Street Capital and
sure.
the guys in upstate New York. My point is, what you just talked about is the whole key to investing. The deals because we were a mezz guy, minority equity, sub debt.
Mm-hmm.
The deals that went awry with the firms that were arrogant SOBs usually came from Apollo or somewhere, and all of a sudden they thought any dope can play in the lower middle market. They were arrogant. They didn't get the culture. They didn't give a damn about ethics.
Yep.
And they screwed up the companies. And as you well know, because that's what you're going after, I'd say a quarter of the companies you go after are what you want. A family-owned business, they don't want to sell to the highest bidder. An entrepreneur, it's his baby. He's 50. He wants to hang in for 10 years, but his kid can't afford Syracuse, which costs $75,000 a year, so he needs some liquidity.
Mm-hmm.
But they want to hang in there. So they work with you. And it's the team. And investing, I think people who aren't in finance think every owner just wants the biggest paycheck. They don't.
Yep.
And your model, that's why I asked that question. Berkshire Hathaway, I agree. I don't like their model anyway, because I think it's buy and hold forever, and I don't care. You're much more involved. But the buy and hold appeals to a lot of sellers. But you got to get the right guy or woman. Not everybody, because last quick comment, interviewing a lot of these guys with the PE firms, what I always did, and this sounds silly, but it worked. You go into the guy's office and you look around and what are the pictures he has? And does he have his, if he has his trophy from winning the Monsignor Martin Catholic League thing 40 years ago, he's never left the hard court. You don't want to go with him. But he's got his family and stuff like that. He's got the ethics. But you also asked the question, and it was the idiot savant question, where do you want to be in 3 years? Mm-hmm. And I had a couple guys literally say, I got a house in Corolla or Duck, Carolina, and my kids and wife are there all summer, and I can't see them. I really want to spend more time there. Well, God bless them, but that's not the guy I'm going to invest with. You want a guy that loves his family, but has still got his heart in there. So a lot of the successful investments are exactly what you're talking about. You get into the head of the guy, and it's a team. If it's not a team, it doesn't work. Yeah, it doesn't work, and that sounds basic. But it's no different than playing basketball. If you got a guy that wants to score 40 points a game, you're not going to win the game.
Yeah. Tom, these are really great comments. It's funny. I mean, we're totally aligned on all this. You made a really interesting comment about middle market and buyout firms kind of pushing into lower middle market and thinking that they know it all. I mean, there's just such a huge difference between running a company, overseeing a company, investing a company, building teams for a company that has 50 to 100 million in EBITDA versus 5 to 10. I mean, the resource constraints at a 5 to 10 million dollar EBITDA business are just, it's like a different universe than a 50 to 100 million dollar EBITDA business. And so, where we've seen what we think are some questionable moves and questionable valuations of companies that have gone for, again, what I'd characterize as irresponsible multiples is when, the kind of upstream buyers start to push into, lower middle market and apply their same methodology. They can cause prices to go up, valuations to go up. But the reality of it is those companies, they're still going to have the same issues, with executing growth strategies to grow the company that they were going to have, regardless of who the sponsor is of the deal. So, but really, really appreciate the comments. I mean, that's great stuff. And,
well, it's funny. I've been on a lot of panels over the years, and I was on one. This is a quick comment. I was with a guy who came from a huge fund and was now with a middle market fund. And the guys in the audience were CEOs and CFOs, and they said, gosh, what do you look for in a good investment? What's more important to you, the product or the team and the people? And I said, well, let me answer that. I said, I'll put it in grade terms. I'll take an A team and a B product any day of the year.
Absolutely.
Over an A product and a B team. And this idiot next to me actually said, because these were prospective clients, it's interesting to say that, we don't care. He said, literally, we don't care as much about the management. You can always replace the CEO. I thought, what a dumb bastard.
Yeah.
One, you're
not
wrong.
that
Two, how
simple.
could you be that crass to say that to people that are,
Yeah, it's just not that simple.
No.
I mean, to think that you can just substitute out people that are in critical roles at a company. And now, I mean, that's not to say the teams can't be augmented, can't be.
Oh, sure.
But you need a foundation. There needs to be, a foundation of a good culture. Maybe that culture needs to be augmented. Maybe it needs to be, reinvigorated. Maybe there's gaps on the executive leadership team. Like, a lot of lower middle market businesses, sometimes the owner plays the role of CFO. And they have like an accounting manager or a controller that kind of turns the gears and does basic financial reporting, but they're making the strategic financial decisions, not their employees. And sometimes it's the case that the owner is also the chief sales officer, chief revenue officer. I mean, and that's not at all uncommon in a 5 or 7.
Cursing and a blessing too.
Yeah, exactly. It's great. But then the question is, well, how do you transition those relationships? And, how do you identify the right executive that's going to, embrace the culture, but then grow it and augment it, and embrace the relationships that exist and transition the important relationships, and then go out and find new ones. I mean, it's hard. It's not, hey, we'll just do a search and insert, chief sales officer candidate in this role, and then they'll be successful. I mean, it's a lot more.
It's not a plug and play.
Not at all. Not at all.
By the way, one quick non-business comment. Owen Ortolani, I think his dad must be Tim. His father was at my wedding 40 years ago. Just to make a Buffalo connection.
That's great.
Thanks.
Thanks for joining, Tom. I appreciate it.
Yeah, absolutely.
Good stuff, guys. Anybody else want to jump in? All right, Sam, I had another question for you.
Sure.
With COVID, we've obviously seen a dramatic decrease in consumer spending. Does that make you less likely to invest in a business-to-consumer business, or is it more likely? Or you kind of talked about e-commerce a little bit and managing that gap.
Depends on the products. I could tell you that. I love consumer products, but I really only like certain categories. I think that some are fleeting and some really have staying power. I think some have tailwinds and I think some have headwinds. And I think it's really situational, but consumer products in general, I really like. I think that, we've had really good success with consumer products companies, and watching how they've grown. I'll give you Amazon as a perfect, an Amazon example. I can't tell you how many people I've talked to over the last 2 years that think, well, how much protection do you have on Amazon? I could just source a product from anywhere in the world and I can wing it up on Amazon and make a few bucks. Well, that's true. But that totally undersells the difficulty in building a true consumer product brand. I've also heard people say, well, Amazon can what if they just start sourcing their own product and selling their own product? And they've done that in pockets, but they've also had a lot of negative publicity about that, especially over the last 6 months, and even on an accelerating basis. I was talking to an institutional investor partner of ours earlier this week, and he characterized Amazon in a really unique way that I hadn't heard before. He said, to the extent that 60% of a given consumer product category, to the extent that 60% of their sales are on Amazon, if you look at a company that sells that category of products and 60% of their revenue isn't coming from Amazon, that probably means that they're leaving a lot of money on the table. And I thought, wow, what an interesting way to look at that channel. What an interesting way to articulate that Amazon really is a channel and it's not just a customer. But I guess long-winded answer to say, I've spent probably 50% of my time over the last few years at Lorraine focused on portfolio companies that are consumer products companies and focusing on acquisitions that have significant direct-to-consumer product bent to them. And so I'm, still pretty bullish on it overall.
Awesome. Derek Tapper's got a question for you. Have you or would you consider investing in foreign companies?
We haven't, but it doesn't mean that we wouldn't. What I would say is, we've actively had the conversation, should we be looking in Southern Ontario as part of our footprint? And we haven't for a couple reasons. One, the size and scale of the companies that we're buying, and kind of the operating leverage that gives us at the Lorraine level. Probably a foreign transaction would likely present too much friction, both with the transaction itself and then, from an oversight perspective, travel and logistics and those sorts of things. But it doesn't mean that it can't happen or that it won't happen. It hasn't yet, and it hasn't been a focus.
Got it. Right, it's about 5:54. You good for one or two more questions?
Sure. Yeah.
Cool. So this is one you and I talked about the other day, and one of my favorites. What do you think holds Buffalo back in comparison to other Rust Belt cities? So, we've got the Clevelands and the Pittsburghs of the world that seem to be a little ahead of us in terms of, business investment and entrepreneurship. What do we do in Buffalo to achieve the same level of success?
So obviously we talked about that. I love this question because it's a multifaceted answer. I think the first thing that I would say is there's a lot that we're doing right now. And I think that that's become a more prominent focus of people that are connected to entrepreneurship communities in Buffalo. An example that I'm super proud to be partners with Bill Maggio. Bill is super involved in so many different entrepreneurial endeavors that take place in this community, from being a co-founder and former chairman of 43 North, board member of 43 North, to bringing Facebook here for the Ignite Buffalo program. Bill has been a huge facilitator and catalyst for many of the things that entrepreneurially are going right, which is just it's cool to be part of that. In terms of, I would acknowledge, I think that we're behind. We are behind some of our neighbors. I think some of that has to do with stuff that we can't control, and that's our scale. When you look at, Buffalo, Western New York region compared to Northeast Ohio, for example, we're smaller. There's just no question about it. They're measurably larger than us. There's measurably more wealth there. There's measurably more businesses throughout lower middle market, and larger companies too. I'd say the same is largely true for Pittsburgh as well. I think those are two cities that always kind of come up from a comparative perspective. So, I think that there's, we can't control that. At one time, I think was Buffalo the 5th largest city? Do I have that right? I don't know. That might be wrong. But
it was up there.
Yeah, Buffalo was big, and one of the things that I've done with the family during this unique quarter, I throw the girls in the car and we drive around Buffalo, and I show them different landmarks. And so I drove them a couple weeks ago on a rainy day. We went down to Central Terminal, and we drove around the Central Terminal. I told them what it was, and I told them how long it's been vacant and what it used to be used for and why it went vacant and what jobs left Buffalo and why. There's a robust history and a roadmap that got us to kind of where we were when the calendar flipped 2000. I do think, in the last 10 years, and I don't have the statistics in front of me, but the investments, private and public investments that have been made, and, I'm sitting right now in a 150-year-old brick building that we redeveloped that sat vacant for 40 years. And up until 4 years ago was still vacant in Larkinville, which up until a decade ago was an industrial wasteland, and now is a vibrant community that people want to spend their time, that's, seeing an explosive growth in housing and amenities. There's a Paula's Donuts that's going to open up down the road that, terrifies me and Spencer. So there's a lot that's going on over the last 10 years, and I think it just needs to continue to accelerate. I will say that, I think that there are a variety of factors that I think will make Buffalo a really compelling place to live and work for the next 50 years. And I'm talking long-term factors. I think that what's going on right now certainly could become the personal and business thesis for people to not want to live stacked on top of each other in megacities. Buffalo's got a lot of land. We got access to natural resources and water. We got all 4 seasons. You can go to the beach and go skiing. There's a lot of pluses here. And with, climate change, regardless of what you think about it politically, our climate is changing. There have been many international studies that have pointed to cities like Buffalo as being an optimum place from a climate change perspective to live, grow, invest, et cetera. So I think there's some, kind of things going right that we can't control. I think there are things that need to continue to grow right and be amplified that we can control. And hopefully there's enough momentum and people looking at it now that we will.
I think you must have been on last week's call with Dr. McFadden talking about climate change there.
I wasn't. I wish I was, though. I'll have to pay closer attention.
So I'll open it up one more time if anybody's got any other questions. All right, Sam, it's about 6 o'clock now. I just want to thank you for taking the time, for leaving your wife and kids and going to the office and putting on
my pleasure,
your nicest Under Armour shirt for us. I appreciate it. I appreciate you taking the time to talk to us today. For everyone on the call, thank you so much for joining us today. We do have 2 more that we just confirmed. Dr. Cosgrove runs the Mercy Hospital emergency room. He's going to talk to us a little bit about what's going on over there and the effects of COVID that they're seeing and how they're handling it. And then the week after that, we've got Leo Rocco, who, if you've ever ordered Starbucks on their app, Leo is the one that designed that technology. So he's going to be joining us on June 4th. So please take a look at those, and we'll have registration up shortly for those. But Sam, thanks again. It's always good to see you. Thanks for coming and talking to us about all the wonderful things going on in Buffalo, and congratulations to you on everything that you've done, and keep up the good work. We're proud of you.
Thank you, sir. I appreciate it.
Jay, very quick question. So I was 70. There was a Frank Cosgrove who was center of the basketball team. Is that the same guy?
Could be.
He was 3 years ahead of me. I was an Akron.
Oh, that's I'm sorry. You're talking about, no, it's Ed Cosgrove. I don't know if
must be a brother.
Yeah.
Yeah, must be a brother.
Cousin.
Well, if you want a trip down Canisius High memory lane, give me a call.
I knew Zablocki would know.
That's right.
Thanks, Paul.
Hey, great talk, Sam. Really was really good.
Thank you, Tom. Thanks for joining. Appreciate the
Absolutely.
participation too. It'd be great.
I got a deal for you. I just emailed Spencer.
Upstate
New York. You will love the deal.
That's perfect. Thanks, man. I appreciate it.
If you don't like this, you got to change your investment criteria.
And everybody tune in next week for Tom's.
Does Canisius get a little bit of this deal because it was a Canisius event that brought us together? I mean,
now we're into the Labatt Blue section of the happy hour.
I had jugged my first day. I still hold the record.
Awesome. Thanks, guys.
Thanks for calling.
See you guys.
All right. Take
care.
care.
There's a couple more.
What?
You are unmuted by host. Okay.
Hey there. Sorry, I'm just trying to clear everybody out. Didn't mean to unmute you there.
Oh, okay. No problem. You're welcome. Bye-bye.
Bye-bye.
My husband graduated from Canisius in what year, hon? 60.
1960. I'm old.
Oh, that's awesome. Glad
Yeah.
you could join us today.
Yeah, thanks.
You got it. Take care.
Bye-bye.
That was great. Hold on.
I got Sammy boy. Let me call you back.
Yeah.
All right.
I'm getting out of this.
All right. What's up, stud?